Hey Bowtie Nation, the new year means a new investing strategy, and with the stock market up over 20% last year, how you invest in 2024 could take your portfolio even further. But your goals, your need for return may not be the same as mine or any other investor. Why should you invest the same? That's why I'm going to show you 3 different ways to invest $1,000 in stocks, a portfolio for every type of investor. Whether you're a dividend investor that loves cash flow, someone that needs stable or safe investments like in a retirement portfolio, or if you want to 10x your money in growth stocks, there will be a portfolio for you. So let's get started with our dividend portfolio and Main Street Capital, ticker MAIN, with its 6.7% dividend yield with each portfolio. And again, I'm going to be sharing 3 portfolios here with different goals, so you can find one no matter what your needs. But in each of these, I'm going to show you 2 stocks and an ETF that is going to build the base of your portfolio. I'll also explain who the portfolio is best for to make sure it's best for your goals. As a business development corporation, Main specializes in loans and equity investments into mid-sized businesses. The company has 182 portfolio investments as of the first quarter, with the largest representing just 3% of the total fair value. So a hit to any of these investments isn't going to hurt the shares much. Now, Main Street isn't the highest paying monthly dividend stock, but it is the most consistent and dependable that I've found. The dividend hasn't been cut in the last 5 years and has grown at a steady 3% pace. This one even produced a positive price return, so dividends and price appreciation. But the biggest part of why Main has been my favorite monthly dividend stock is the yield it collects on those loans is so much higher than its dividend yield. With an average yield on its portfolio over 12%, it's collecting more than enough to pay that 7% dividend and reinvest in the business for growth. That not only means dividend sustainability, but also stock price returns over time. So besides in this cash flow dividend portfolio, you could probably include this one in a safe retirement portfolio as well. This next stock in our $1,000 dividend portfolio is one of my favorite REITs, WP Carey, ticker WPC, and its 5.3% dividend. WPC is a $17 billion REIT with great diversification across property type. In fact, pretty evenly spread across industrial, warehouse, office, and retail space. Most of the portfolio is in the US, though it does hold just over 35% of the properties in Europe, which gives it great geographical diversification also. And it's that diversification is really why I like WPC as one of my favorite dividend REITs to start a portfolio. Against the other real estate stocks I follow, only WP Carey has the exposure to both different property types that I believe can really bring the risk down in your portfolio. The company collects over $1.1 billion in annualized base rent and books 98% occupancy, over 131 million square feet across more than 1,100 properties. Now, obviously, the office side of the portfolio has dragged down the shares over the last year, but there is enough diversification here that evens out that overall performance. WPC has topped expectations for funds from operations, that important FFO measure over the last year, to report $5.09 per share. Now we see here in this NAREIT data that the shares are now trading for about 10.3 times on that price to FFO per share basis. That is very cheap against the historical average, around 16 times. So you're getting a solid dividend here, and what should be good price upside potential. For this dividend portfolio, the goal is going to be to find those strong dividend stocks, around 5% yield, but also with good long-term price appreciation. You're going to want to reinvest those dividends, buying more shares for as long as you can to build on that portfolio until you're living off your dividends. Dividend investing is one of the most popular themes on the channel, and for good reason. This portfolio is perfect for those of you that want that guarantee that you're always going to have cash coming into your account, cash dividends that are going to be there when you need them. Dividend investing is one of the best ways to invest because you're going to be motivated to keep saving and investing every time you see that dividend check hit your account. And here we're adding one of my favorite dividend funds next, the Schwab US Dividend ETF, ticker SCHD, with its 3.5% dividend. Now, this isn't going to be as high a dividend as those individual stocks, but it's going to give you the ultimate in dividend diversification. The Schwab fund has beaten other dividend funds on a regular basis and has produced a 13% annualized return over the past 5 years. So there's that solid growth here as well. That Schwab ETF holds shares of 100 of the highest dividend payers within the large cap US market and includes a lot of the faster tech growth stock as well. Tech makes up about 20% of the fund, giving it a return plus that higher 3.5% dividend yield. And you can see the fund covers all its bases here with Coke and Pepsi, but also some of those dividend stocks you might not see in those other funds, like the Cisco Systems and Broadcom. Now it's up to you exactly how much you invest in these stocks in your portfolio, but those of you in the nation know I'm a big believer of the core satellite strategy. And this is where you have maybe 50 or 60% of your money in those few broad exchange traded funds like the SCHD that we talked about to get that market return on the theme. With this part of the portfolio, you're not trying to be the market, you're just trying to be the market and get that consistent long-term return. So in our $1,000 example here, you might invest $500 or $600 in that SCHD ETF or split across a couple of dividend ETFs. Then with the remaining $400 or $500 of your $1,000 portfolio, you'd split that across individual stocks like Maine and WPC in our dividend example. That's going to give you the opportunity to get that higher cash flow from those higher yields or just a higher return in some of your other portfolio examples we'll talk about. But let's get started on a retirement portfolio for anyone that wants that ultimate in safety. And here we're going with utility provider, the Southern Company, ticker SO. The company operates as a regulated electric utility, serving more than 4 million customers in Georgia, Alabama, and Mississippi, along with another 4.4 million customers in natural gas. And Southern is one of the most aggressive in the utilities industry for its push into clean energy. In 2000, nearly 80% of the company's electricity generation came from coal. Today, it's just 20%, and the company is pushing further into nuclear, natural gas, and renewables than anyone else. Of course, stocks of utility companies were slammed last year, with the sector down 11.5% as those higher rates in money market funds pulled investors out of dividend stocks like Southern Company. But that could reverse in 2024 with lower interest rates and rebounding stock prices for these stocks. Either way, though, utility companies book some of the most stable cash flows in the market. So long term, the stock price is going to rise, giving you that dependable upside appreciation plus the dividend. And I like healthcare giant United Health Group, ticker UNH, for a retirement portfolio for two reasons here. First, anytime you can match your investments to your biggest expenses, as your bills go up, so will your portfolio. With healthcare accounting for nearly a third of retiree expenses, United Health is going to see that money from insurance, pharmacy, and services. UNH controls 15% of the U.S. health insurance market, well above its next largest competitor, and serves 1 in 5 seniors through its plans. Also, though, United Healthcare's acquisition of data provider Change Healthcare last year gave it what could be an unfair advantage over its competitors. In fact, the Department of Justice tried to block the acquisition for just that reason, but was shut down by the courts, allowing the deal to go through. The shares have lagged the market over the last year as the company works through that integration, but the outcome is the same. That Change Healthcare acquisition gave UNH data directly from its competitors' operations, as well as just solidified its market share dominance. Not only does the company build on growing cash flows to the sector over the next few years, but I think it uses those advantages to expand its dominance for outsized returns. UNH booked strong revenue and earnings growth this year and is expected to reach $27.91 in earnings per share next year. That would put it at just under 19 times on a price-to-earnings basis, which is in deep value territory for this stock. We've still got our safety portfolio ETF and 10x growth portfolio to highlight, but you're probably asking, why do you need a portfolio goal like this anyway? Why focus your investments on a goal like dividends or safety stocks or that 10x growth? Why not just pick individual stocks you like whenever you find them? Well, let me ask you another question. Would you leave for a cross-country trip without even knowing how to get there? Hell no, you wouldn't. If you want to end up 1,000 miles somewhere else, you better think about how you're going to get there. What way is going to be the fastest, easiest, or just less expensive? So bringing this around, why then would you set off to meet your investing goals, which are even more important, without understanding which stocks are going to get you there the fastest, the easiest, which are the best stocks for you? That's why I created this quick 3-step guide to making your investing plan, finding out what type of investor you are. Within 5 minutes, you'll be able to create an investing plan that makes your goals the motivation to keep investing, and that is customized to your needs. I'll leave a link to that below in the description. It's totally free, just something I wanted to do for all you out there in the community. So click through and get your step-by-step guide. Folks, I've seen too many investors miss out on the opportunity to make their money work for them, and it's because they didn't have a plan that fit their needs. So look for that link below and get your free customized plan. Now, arguably, the safest, most stress-free way to invest would just be to buy the market like the iShares S&P 500 ETF, the ticker IVV, holding the 500 largest companies in the United States. This is your overall stock market fund, an index fund that's going to give you that growth of the market by investing in the market. In fact, you can see here how closely this ETF has tracked that index in its returns, nearly identical returns to the S&P 500 stock market index. And again, the fund does this not by trying to beat the index, but by being the index. It holds the S&P 500 companies in the same weight as they are held in that stock market index. You can see the top 10 here, or download all 500 from the website. Heavyweights like Apple, Microsoft, Amazon and Nvidia. And I know that's going to irk some of the Vanguard fans out there, so I want to explain why I'm going with the iShares fund instead of maybe the VOO or the VT. So why not invest in the Vanguard Total World Stock ETF, the VT instead? I mean, wouldn't owning the entire world stock market be better than just the US stocks? But there are two problems here. First, the Vanguard fund charges you twice as much to invest. You pay a 0.07% expense fee to hold shares of the VT versus just 0.03% to hold shares of that iShares S&P fund. And yeah, 0.07% isn't a lot, and maybe it's worth it to get that world stock market instead of just S&P 500. Except look at the top holdings of the Vanguard Total World ETF. Does it look familiar? Well, here I'll put up the top 10 stocks in the S&P 500 fund. Now do you see the similarity? Because the World Stock Market Fund is weighted by company size, more than 60% of it are in those companies from the S&P 500, the largest companies in the US. So besides paying twice as much to hold nearly the same group of stocks, that 40% in the world stock market outside the US, in my opinion, just slows down the growth that you get from the best companies in the world. We're into our 10x growth portfolio, and one of my favorites, SoFi Technologies, ticker SOFI. Despite the shares being up 110% last year, this is still a tiny company when it comes to banking, and that means a lot of room for growth. Even at nearly 7 million users of its financial products and lending, SoFi is still growing membership at more than 40% a year. That's helping it to drive revenue growth of 27% on an annual basis, and how management expects to hit profitability this year. I know, all you out there in the nation are probably tired of hearing me talking about SoFi. We're up 70% since starting the position, and it's one of my biggest holdings in my portfolio. And it all goes back to the company's charter as a bank, a distinct advantage over other fintech companies. It means lower funding costs and more services available, all translating to that cheaper and faster growth. And SoFi was one of the few banks to actually grow its deposits through the banking crisis of last year, but even growing to about $16 billion in deposits, it'd still only make it 125th largest bank in the US. That's why I believe with SoFi's advantages, it can easily grow to a bank 10 times that size and take investors along for the ride. I'm going to highlight two more growth stocks, but I'm not recommending, even for you growth investors out there, that you put all your money into just these three stocks. Finding more of those long-term stocks for your portfolio is about spotting the biggest trends for the next decade and the companies that are going to benefit most. And first is just finding a long-term trend supporting the industry. It's one of the reasons why even though oil stocks made us a lot of money a couple of years ago, and I do like energy stocks for the next few years, but why you won't find any of them on this list. We just don't know what that longer-term trend is for the industry. Instead, I'm looking for industries like e-commerce, artificial intelligence, VR, and lending. There's always going to be disruption in any industry, but in groups like these, the upward trend from electrification, online usage, and economic growth is going to help drive all the stocks in that industry. And once we found that industry with the positive upward trends, I want to find the companies with a competitive advantage in the group. The company has to be able to do something few others in that industry are doing, something it's going to use to leverage that industry growth into even higher returns. That's going to give it staying power even when the economy tumbles in the bear markets over those decades. Finally here, for those reliable buy and hold stocks, we have to come back to that valuation. Even a good company with a strong industry trend can lose money if the stock is just ridiculously expensive. Now I want to get back to our list, but I made a video in the corner here to show how to analyze any stock. It's a quick 5-minute process that you can use the next time you're looking for stocks to buy. A ChargePoint Holdings, ticker CHPT, was my worst stock last year, but I still believe this one can 10x your money. The slowdown in EV sales and some bad management decisions meant ChargePoint only grew sales by about 10% last year, well under the previous estimates. Management was booted in November, and the company is trying to get back on track for that solid growth. And here, is there any doubt the direction is still towards electric vehicles? Even if those prior estimates on EV sales growth are revised lower on last year's weakness, we should still see upwards of 3 million EVs sold a year by 2030. That would be nearly 3 times the amount sold last year, and still just 18% of the car market. And we know that charging is the bottleneck for growth in EV, and we're going to see some massive government funding from the IRA coming online this year. ChargePoint revenue growth is directly proportional to EV sales, and it's going to enjoy that long-term growth. Looking for that competitive advantage, the company is the dominant player in charging infrastructure, with more than 70% of the U.S. public chargers. It's compatible with Tesla charging standard and has no debt due until 2028. This company has a long runway for growth. For our growth ETF, I wanted to find a fund that encompassed all the 10x themes and found the iShares Exponential Technologies Fund, ticker XT. Rather than being constrained by just one growth theme like artificial intelligence, self-driving, or robotics, This fund gives you exposure to stocks across all of them, technologies displacing the old ways and creating new markets. The fund holds shares of 200 companies across solar, AI, semiconductors, and with all the growth themes roughly the same weightings for each stock, that means you get a diversified growth portfolio, including some geographic exposure with stocks enlisted in foreign countries. Make sure to look for that link in the description below and get your free customized investing plan. Don't invest until you know how to match your stocks with your goals. Or click on the video to the right for that simple 5-minute process to analyze any stock. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.